Financial statement analysis is great. Computing financial ratios is great, but there's some potential pitfalls. Let's be careful out there. Here are 4 potential pitfalls that you need to be careful of when you do financial statement analysis. First, you need to remember that financial statements do not contain all information. They're great, but they don't contain everything. Second, sometimes one company's financial statements aren't comparable to another company's financial statements. So trying to compare them, you're just going to get nonsense. Third, sometimes we think that doing financial analysis is solving a mystery, like a TV show or a movie. We search for the smoking gun. Well, there usually isn't a smoking gun. And finally, anchoring and adjustment and timeliness. We need to remember that historical information is great, but the stuff that happened just yesterday may even be more important. Tough for me to say this, but financial statements do not contain all information. They're only one part of the information spectrum. How do you like that word? Don't let the attractiveness of the apparent precision of the numbers distract you from saying, well, yeah, but there are other information that I got to get that's a little messier. I need to talk to people, personal relationship, marketing plans, market forces, industry, general economic trends. All those things are incredibly important, sometimes more important than the financial statement numbers, but the financial statement numbers seem so precise, and we can compute ratios, and we get them down to 47 decimal points if we want to. Don't forget that financial statements are just one slice of the information spectrum. If you see somebody making their decisions just based on financial statements, you're seeing somebody who's not being very wise, in my opinion. They should be looking at lots more stuff. The purpose of accounting rules and accounting standards is to make it so financial statements are comparable, but sometimes they're not comparable. There's some wiggle room within the accounting standards. Sometimes companies use different classifications. I saw a shocking illustration of this the other day. I was looking at the financial statements of Nordstrom's. I mean, who knows when I might go to Nordstrom's, although you can see from the shirt I'm wearing, I don't go there very often. But I looked at the financial statements of Nordstrom's, and I saw that in their cost of goods sold number, they had also included rent. So they had one combined number in their income statement, cost of goods sold and rent together. Other companies that do similar, that are in the same line of business, they report cost of goods sold and rent separately. So if I compare just the line cost of goods sold Nordstrom's and cost of goods sold somebody else, they're not comparable because Nordstrom's has classified their rent as part of cost of goods sold. So I just can't compare those numbers. They're no longer comparable. Sometimes I'm looking at a conglomerate, a business like General Electric that does all kinds of different things. So whose financial statements do I compare them to? Because they make electricity, or they make light bulbs, they make locomotives, they lease airplanes. Well, what do? They do all kinds of different things. So it's hard to find a company to which to compare them. A conglomerate does lots of different types of business. Some companies use different accounting practices from other companies that are in similar lines of business, but they use different accounting practices. So maybe they make their depreciation estimates differently. Or one of my favorite examples, when you study inventory accounting in detail, which you may already have done, you know about LIFO and FIFO. Sometimes when times of inflation, you assume that you sell the old goods, and that's what your cost of goods sold is based on. Sometimes you assume that you sell the new goods. That's called LIFO. Your cost of goods sold is based on that. Well, companies can do that differently. One company can assume they sell the old goods, FIFO. Another company can assume they sell the new goods, LIFO. Their cost of goods sold numbers are then not comparable because they're using different accounting practices. You need to be careful. You just can't close your eyes and go online and download a bunch of numbers and say, now I'm going to compare these companies. If you're doing a careful analysis, realize that the numbers may not be comparable. You got to be careful. There's a caution, a potential pitfall with financial statement analysis.